Hi, this is Rick DeLuca with the DeLuca Real Estate Group, and we're here providing you information to help you be a better real estate investor. Today we have with us Chris Busse with Guardian Mortgage.
Hello.
So Chris, tell us a little bit briefly about yourself and about Guardian Mortgage.
Sure. Thanks for having me, Rick. My name is Chris Busse. I'm a loan originator with Guardian Mortgage. We are a mortgage company that is part of a bank. But we operate just like any other, kind of mortgage banker would. So we have the benefit of having a bank wrapped around us, which allows us to do some additional types of financing, portfolio lending, all the traditional stuff, but some added benefits there. So it's a great company. Been there since 2018. I've been in the industry overall for about 18 years now.
Okay. So we've worked with you in the past. So like Chris said, he can do things like a mortgage broker, but he's a bank. So we're talking about real estate investing. So why are we speaking to someone who works at a bank? Because typically we speak with our real estate investors and we say, hey, don't go to the bank because the bank thinks inside of a box.
Exactly.
And can't think outside a box. So the reason is because a lot of times we do like investor consultations, and 9 times out of 10 we find out that a lot of the goals they're trying to achieve can be done through traditional lending. But with that caveat that the lender has to know what they're doing and think outside the box.
Yep, that's exactly correct. Again, we operate just like any other mortgage company does. Doesn't matter that we have a bank wrapped around us. I think that's the best way to kind of look at it. We can do anything that any mortgage company can, and we just do it. We do it really well, though. We have some great processes and systems in place to make the whole file flow really smooth. So when it comes to investors, I work with them very often, helping to either prepare them to buy a home, whether it be in an immediate couple months, whether it be 6 months to a year, maybe even 2 years down the road, because sometimes it just takes that long to get people ready to be able to purchase.
Okay. So we've worked together several times, and it's always been great. But a lot of times, so we get somebody in a house, and then they come back to us right away or soon afterwards and say that they want to do real estate investing, right?
Yeah.
So a lot of people come and they're like, how do we do this? And so what's come up now is it's been around for a while, the DSCR loan, right? Yep. But it's becoming more and more popular. So we kind of want to go over that. What exactly is it, and how does it work?
Yeah.
So what does it stand for, I guess, first?
The debt service, DSCR is debt service coverage ratio loan. And basically what it is kind of a old school no income qualification loan. Okay. We are solely using the cash flow of that particular subject property to determine the eligibility for the borrower. So it is not based on if you're a self-employed individual. We don't need tax returns. We don't need pay stubs. We don't need W-2s. No. It is solely off of the calculation of the cash flow of the property. So it is key to make sure that you are buying a property that is going to cash flow well enough to be able to meet the standards of that DSCR lender. And typically they're looking for somewhere between 1.00 up to maybe 1.4 on the ratio of the monthly payment to the cash flow of the property.
Okay.
Rent.
Let's kind of go
dissect that.
There's a lot of stuff in there. So, all right, let's start at the beginning. So I want to buy a property, and I go to someone, a lender, find it, or an agent, find it. And so usually like the first thing is like down payment. So what's that look like? Is there a down payment? What's the percentage? How's that go?
Yeah, the DSCR programs that I've seen, I've access to, are typically going to be 20% down minimum. Which, if you're buying an investment property these days, even if you can qualify for a conventional loan, you typically want to see 20 to 25% down anyhow. So 20% down seems to be the minimum. What I do want to point out is you always need to check with your lender and see what their programs, what banks they have it eligible through, and the market that you're buying in, because I've seen most of these lenders that are considered non-QM lenders, a lot of times they will have a reduction in that maximum loan to value in a declining market. And so got to bring that up these days just because
All right.
different markets can be a little different.
So what's non-QM?
Non-QM is a non-qualified mortgage loan. So that's what these loans fall under. You get a loan, if we do a conventional loan, an FHA loan, a VA loan, those are all qualified mortgages under the Dodd-Frank Act, and so because they meet certain requirements. Loans like this that do not, like when you're not qualifying based off of income, so you do not have a debt to income ratio, they fall under the non-qualified mortgage category.
Okay.
And so there's certain lenders that are able to do that are willing to do these loans. They essentially just package these up, typically sell them off to hedge funds and stuff.
Okay, I got it. So it's not like a traditional bank loan. It's not necessarily the fully private money, hard money loans.
Yep.
It's kind of like somewhere in between.
That's exactly the way I kind of describe it. And the interest rates kind of reflect that too, which I'm sure we'll get to.
All right. And we know there's all these sometimes hoops and things and underwriting got to go through. So are these things a little bit easier to get through with underwriting, or?
Not yes and no. From an income standpoint, yes. So personally, what I do is when I have an investor that would like to purchase a rental property, the first thing I'm going to do is see, can we get them qualified on a conventional loan, standard traditional financing? How do those tax returns look, and is it possible to get done? If not, then we look at maybe one of these DSCR loans. The guidelines on these can be a bit. It's quite a bit more required than a conventional loan. They want to see 12-month housing expense with no 30-day lates. They want to see reserves maybe 6 to 12 months for each investment property that you might own. There's certain sometimes trade line requirements. So there's actually a little bit more because they're not basing it off of your income, right? So they don't. Right. They're doing everything off of credit and basically your overall financial picture minus the income. Okay. So it's a little bit riskier of a loan.
So I heard some lenders, and I asked them, and they're like, "Oh yeah, like 1.4, 1.8, 1. They'll throw these numbers out. What does that mean?"
That's that coverage ratio. So basically what you want to look at is what is your monthly payment going to be? Principal, interest, taxes, and insurance. What will the total mortgage payment be for that property?
All right.
And then how much can it rent for? And you basically just divide one by the other to determine what that ratio is. So the total, if the payment's $2,500 and your rent is $2,500, you've got a 1.00 ratio, right? So obviously the higher the rent is on that property and the lower the monthly payment, the higher that debt ratio, that service coverage ratio goes.
And what is it usually?
You want to see minimum needs to be 1%. If you're under 1%, I think there's some lenders that'll do it maybe.
So you can kind of break even sometimes on those?
You can, if you're breaking even, but you don't really want to break even on an investment property anyways. But if you did, yes. And a lot of times your interest rate will be determined based on what that ratio is.
So your interest rate can...
It could be, sometimes it might require larger down payment if it's a lower ratio. Okay. So if you got a 1.4, 1.6, a lot of times you're going to see more favorable interest rates. Maybe those higher the higher loan to values, the lower down payment option at the 20%.
So it's not like set in stone. This.
No, it can vary. I've seen especially the interest rates. If you're at a 1.00 to 1.10, it would be X, and then 1.1 to 1.2. So again, less risk to the bank, the higher that ratio is.
Okay, and so let's say it's a 1. Given like the interest rate, what it is. So if it's a 1.0, is the interest rate going to be like a 0.25% higher, 0.5% higher?
It could be. Yeah, it could be a quarter. It could be 0.5%. Okay. I don't think it's going to range like much more than that.
And if it's like a 1.25, are you kind of at like a regular?
These are all going to be
higher.
They're all going to be starting with an 8 to a 9, maybe even higher than that. Yeah, at this point right now, as of today, you're probably seeing 8-9% on these. Okay. Again, it's
so
really in between.
Cash flow.
You've got to cash flow.
Okay.
That's a big one, of course, but really, like you were saying before, this is really a loan for that borrower in between a conventional loan and hard money. Okay. It's not going to be as good as conventional. It's not as bad as hard money. It's going to be right there in the middle. And these are business purpose loans. You actually have to sign a document stating that this is for the sole purpose of business. It cannot be a second home, cannot be a primary home. This has to be an investment property for rental purposes.
Okay. All right, so this is kind of clearing things up because a lot of people, we see a lot of information, but I don't see a lot of the breakdown of it. But, everybody's different. Some investors want to just acquire property and they don't care if they break even because they're a lot of times they're hoping on that appreciation, that equity build up. But this loan, it could be used for that, but necessarily, it isn't necessarily the best way to do that for this. You really want to cash flow on these kind of loans.
You really do. That's obviously key. So yeah, if you've got investors who are more about the appreciation of the property value itself, then maybe they'd be okay if it just broke even and you're at a 1.0 ratio, and that's fine for them.
Okay.
But yeah, every borrower is going to be a little bit different based on what they're trying to accomplish, what their financial picture is, and so I just advise you speaking with your lender and asking these questions to them to see what makes sense for you.
Okay. Yeah, thanks a lot. It helps kind of clear it up. A lot of people, they hear it out in the news and other podcasts, and they hear about the DSCR, and they're like, I'm going to go get a rental property but it's not that easy because you got to have some cash still.
You got to have cash.
And then you have to find a property that fits that criteria. I think is probably number 2 most important.
With these interest rates, that cash flow can be a challenge. I mean, properties rent out for quite a bit right now, so it helps out. But the other piece, just another big factor, is monthly housing expense. I had a client here just recently call me that was looking to do something like this. He does not have a primary housing expense, though, and they do require, most lenders that I've seen that do these DSCRs require a primary housing expense, and that we can document a 12-month payment of that. So you can't be somebody who's never really had any sort of a mortgage or any sort of a monthly payment and just going and jumping in and getting something like this.
So it's not like to start off.
No, it's really not. And there could, and again, I qualify this with there's a lot of different lenders out there that do these programs, and I don't have access to all of them. So there always could be something different out there that I may not have access to or haven't seen.
Yeah, everybody's a little. Each lender has their own unique, like some products that kind of make them a little.
And also to clarify, this is not a Guardian Mortgage product. This is going to be through a third-party company that we essentially are brokering this loan to. We do not keep DSCR loans on our portfolio books, no. Okay. So it's so again, you go to any lender out there, and they'll most likely have access to one of these. There's a number of these banks that not banks, financial institutions that do these non-QM loans.
Okay, awesome. All right, I think that clears it up a lot. There's a lot of information, but here we got it straight from someone who does them, for people. So we got it. Appreciate that, Chris.
Absolutely.
So if you guys have any questions, more about DSCR loans or other types of products that Chris offers, give him a call. He works here in Scottsdale, Phoenix area, but of course he can do all over Arizona and in other markets.
Yeah, 43 different states as well.
There you go.
Thanks.
All right. Okay. Thanks, Chris.